Welcome to Financial Accounting, Unit 1. In this unit, we're going to look at the basics and the introduction to financial accounting. Then we'll have review questions based on what I'm going to teach. So to start with, we're going to look at the definition of financial accounting, its purpose, the organizations that can be formed, and the users of financial accounting information. So to account basically emanates from the biblical term to have a report of, an account of. So basically to account is simply to do what? To take account, to set a record, to give an overview. And because of that, we can safely say financial accounting emanates from the Bible. Each one of us has to give an account of how we lived our lives. And so Fma also has this definition of a financial accounting being the classification, the recording of monetary transactions of an entity in accordance with established concepts, principles, accounting standards, and legal requirements and their representation by means of an income statement, a balance sheet, a cash flow statement during or at the end of an accounting period. So this definition outlines the syllabus of financial accounting in its entirety. So there's an issue of classifying and recording of what transactions which should be in monetary form. Now these transactions should be in accordance with established what? Accounting concepts, with established accounting principles, with established accounting standards, and also within the legal framework, as well as their presentation as well. So these are the things that we're going to dominate on in financial accounting. So the purpose of financial accounting basically is subdivided into these 5 key elements. It looks at what assets this firm owns. Whatever the firm owns is called an asset. It also looks at who owes the firm. So the people who owe the firm are called what? Debtors. Then also it looks at what? Who the firm owes. Who does the firm owe? So these are called the creditors. Financial accounting also wants to look at how the firm is financed, their capital structure, whether finances are coming from the retained profit, or whether finances are coming from creditors. Then finally, we want to look at the performance of the company over time. So we're going to look at ratio analysis. All right, so according to accounting information is required for a variety of reasons: to fulfill legal obligations, to assist managers to plan, control, and make decisions. Also, financial accounting is of interest not only to entities or businesses, but to other users of financial accounting information, not non-users, but other users of what? Financial accounting information. So in the context of organization, accounting should take place within any business or organization at a predetermined period, where we're going to now adopt what is called the periodicity concept. So what do we mean by businesses, and what types of businesses do we have? So we have several types of businesses, starting from companies, partnerships, and sole proprietorship. All these are within the 4 legal frameworks that we have in Zambia. We have what we call the Partnerships Act of 1980. We also have what we call the Companies Act, Cap 388 of the laws of Zambia. We also have what we call Cooperatives Act and trusts under the Lands or Perpetual Succession Act. So these ones are the legal framework under which these institutions will operate. So we have a sole trader, a one-man business. We have a partnership. We have a company. We have a cooperative. Now, kindly help me digest the properties of each of them and the advantages and disadvantages. Tell me about a partnership. Let's start with the sole proprietor. What are the characteristics of a sole proprietor? Properties, advantages and disadvantages. Mm-hmm.
So for you said for a sole trader, right?
Mm-hmm.
So capital is not shared.
Mm-hmm.
Yeah, that's for the sole trader.
Mm-hmm.
Yes, and then they make decisions on their own.
Mm-hmm.
Yes. And then for the disadvantages, when they run a loss, they have to deal with it on their own.
Okay,
Yeah.
it's very good. So for a partnership, the characteristics are as follows. An individual owns and operates his business. There is no legal distinction between the individual and the business itself. In terms of liability, the sole trader has what we call unlimited liability because here the debts of the business are the debts of the establishment. In terms of decision making, the owner makes all the decisions. He has absolute decision making. In terms of taxes, he only pays one kind of tax, which is called individual or personal income tax. In terms of capital raising, this person will assume the responsibility of looking for the monies alone. Those are the characteristics. All right. So now, besides the characteristics, we now want to know the advantages of this kind of business structure. What are the merits? Number one, it's easy to set up. Number two, it has full control. Number three, he has privacy because it's doing it alone. Those are very good advantages. So it also has disadvantages. So its advantages are that he has what? Unlimited liability. The other disadvantages, he has limited pool of resources, limited pool of expertise, and also he lacks continuity. When he dies, the business dies with him. Is that clear? So we go to another kind of business structure, which we call partnership. So what happens in a partnership? A partnership, we know people come together to form a partnership under a partnership deed. So this needn't be written, only it can also be oral. So a partnership can have 2 or more persons. Ownership is written or oral. Liability, we have joint liability, meaning a partner is personally liable for the entire partnership's debts. So meaning the individuals that are in this partnership must be very careful to making decisions that will benefit the whole partnership. Anything they mess up, it's also going to bind the other partners. Decision-making, partners can share decisions, engagements in meetings unless otherwise. Taxation, the partners generally pass through entities of tax purposes, meaning their profits are passed through to the partners and they individually are taxed on their share of profits. So capital raising, they combine their resources together to increase the potential. Advantages, there's shared responsibility. Instead of having the burden of one person thinking and doing everything, they share burdens. So is the advantage extended to sharing of what? They share the profit. They also have an advantage that since the resources are pulled together, there's also a pool of expertise. There's flexibility in terms of partners easily able to establish management structures. What are the disadvantages? Disadvantages are unlimited liabilities. Disagreements between the partners can potentially disrupt the partnership itself. Dissolution risks a partnership can be dissolved when one partner leaves, retires, or passes away. They need to start all over again. All right. So we got two companies. What are the characteristics of companies? The companies under our laws of Zambia, Cap 388, allows a company to be incorporated, become a person who can sue and be sued. So what are the characteristics of this company? The ownership here is through sale of shares, and the owners are called shareholders. Liability is limited to the amount that has been invested in the company, and decision-making is by engagement of what we call the board of directors, who handle day-to-day operations of the business. Taxes of the company and the shareholders are individual separate because the company is a separate entity. And capital is raised through issuance of shares. All right. So what are the advantages and disadvantages of this structure of business? So it has its own advantages and disadvantages. To start with, the advantages or the merits are as follows. Number one, the liability of the shareholders is limited to how much they've invested, so it's protected to their investment. There's perpetual continuancy, so if a shareholder dies or changes, somebody else can come without the company dying. There's access to capital. They can raise funds through debentures or borrowing because they're a big company entity. The disadvantage is very complex to set up and expensive. It has so many regulatory scrutiny. They have to present reporting annual reports in the press. They have double taxation from an individual perspective and a corporate perspective. So that is about a company. When we go to cooperatives, what are cooperatives? These are democratically owned entities where members are also the customers. Members are the main customers, in fact. So it is mainly meant to improve the life standards of the what? Of the customers themselves. They will agree to sell at a cheaper price. It's not mainly profit oriented. The liabilities of the members are usually limited to the extent of their investment decision. Each member has one vote regardless of the number of shares, and taxation. Treatment of cooperatives varies in jurisdiction, but they have tax advantages based on the structure. And capital, cooperatives are founded by members who contribute. Their surplus earnings can be reinvested. So this is about a partnership. Now, what are the advantages and disadvantages of a partner? So this partner has its own advantage and disadvantage. So this is how the advantages can be sub-explained. So to start with, there's democratic control. Here, members can have a say on the cooperative's operations. Benefits are shared, the profits are distributed among the members, promoting a sense of community and cooperation and social responsibility. Cooperatives will prioritize the social and environmental goals that will foster sustainability of the community as a whole. Disadvantage is that they have limited access to external capital, so they are limited so much to how much is fundraised by each member. Decision-making, achieving consensus among the partnership may be consuming and may hinder progress. They have limited growth potential because partnerships have a model that is suited to just meet the expectations of the individual members. All right, so as they grow up, they're now evolve into other structures of business. So basically, this is what these types of business entities are all about. So the individual, for a sole trader, is the main source of finance. He has a few employees he can employ. He has some advantages and disadvantages that we have talked about. In a partnership, we've said that it's similar to a sole trader, but can have at least two members. Partnership usually outgrows a sole trader. and it is most common to new businesses. Some friends can come together to introduce some funds in it. So there's on opportunities and disadvantages. So partnership, the agreement can either be formal or informal, meaning court may deduce in a way that partners have been conducting business. All right. Also, examples of partnership will include practice, medical practice, and legal practice. So advantages, I've talked about unlimited liability. For the disadvantages, dependence of the partners, partner ceases when a new member enters, so that I've just explained. Company, talked about it being a separate legal entity, it's treated as a person. So company has its own advantages and disadvantages, run by a board of directors. So we've two kinds of companies, a private and a public limited. Private and public are all guaranteed by shares that are issued. So the word limited is a word that comes in a private limited company, and PLC is what comes in a public limited company. So for a private, they should have a minimum of what? Two, a director, two directors. So a company, they do not invite other public members to buy from their shares that is in the private limited. They can't sell their shares publicly, whereas the public can sell its shares on a stock exchange and they end with PLC. So basically, this is about the different types of companies. Then we go to the users of financial accounting information. So we have internal and external users of financial accounting information. So internal users being the directors, the managers, internal auditors, the employees, external being the lenders, shareholders, government, local authorities, analysts, journalists, competitors, suppliers, external auditors, customers, general public, trade unions, and also potential investors. The question is, how are they users of this information? So to start with, the shareholders here want to know the current and future security of their investment in terms of shares. Potential investors, same, they want to say, if we invest in here, how strong is this company able to maintain our investment? The employees, they need to know the security of their pay rise. Trade unions also want to know their bargaining purposes that increase their salary. They need to also be acquainted to the accounting process. Customers, they want to know if the company continue to supply them in future. So these ones are dependent on the information for their suppliers, and suppliers also want to know if they'll be paid. Competitors also use information to make economic decisions on how they can strategize. Government agencies want to know how the economy is performing. The managers also want to use this financial information for planning and control. Board of directors, they want to use this for strategy development because they are acting on behalf of their shareholders. The lenders also want to know whether they'll be repaid. We also have journalists who use this for public consumption. The general public also wants to see whether these are able to do what we call corporate social responsibility. Tax authorities also want to know how the basis upon which taxes are paid. So basically, those are the users of financial accounting information. So we've already defined our financial accounting according to Fma technology. We also have what we call management accounting, which is simply a process of identifying, measuring, accumulation, analysis, preparation, interpretation, and communication of information used by management to plan, evaluate, control within an entity so as to ensure appropriate use of accountability for its resources. That is what we call management accounting. So for management accounting, this information is mainly used for management and other internal users, whereas so management accounting information is used to prepare budgets, to make decisions about the future activities. So when you're going to look at this table, it just distinguishes and compares the two, financial and management accounting. So the factor for which it is prepared, financial accounting is for external users, whereas management accounting is for internal users. Information that is provided here for financial accounting is used for a period of a year, but this one is used to look at performance, which is compared to a budget that has been projected for the future. The legal requirements for financial accounting is to prepare financial statements according to the framework that has been established. For management, there is no legal requirement. The format for financial accounting is established by international financial reporting standards, but for this one, it's at the discretion of management. The type of information mostly is mandatory, but here it has both mandatory and non-mandatory aspects. Are there any questions so far? A quick can you remember on Unit 1? Which one of the following is not a requirement of the Companies Act in Zambia? Content of the annual report, obligation to pay an annual, a small private company needs to appoint an auditor, the statement of comprehensive statement to be signed. Which one is not? So this one is a requirement of the Companies Act that the comprehensive statement must be signed by the directors, but it is not the job of the Companies Act to determine the content of the annual report, obligations to prepare, and also the small private company, whether they should appoint an auditor or not. Which of the following is an example of an element of equity? Okay. So which one is an element of equity? So some of these ones will come from Unit 2, which I'll teach later on. The objective of financial statements is to provide information useful to what? Users in making decisions. So it is for users and not non-users. So let me go to Unit 2 so that we can complete the other questions together. We now quickly go to what we call the regulatory system of the financial accounting and the rules and regulations. So in this framework, we're going to look at the elements, objectives, and the characteristics which are qualitative for financial accounting. So to start with, already has defined classification and recording of monetary transactions in accordance with the established concepts and principles that are in tandem with the accounting standards. So which accounting standards are we looking at? The accounting standards befit a regulatory framework, which look at number one, the national company legislation. Number two, the international financial reporting standards. Number three, the stock exchange rules. So what are accounting standards? Accounting standards are basically authoritative pronouncements that explain how to deal with specific accounting problems, such as how to evaluate closing stock, how to measure property and equipment, etc. So why do we need accounting standards? The reason is to have a common form or content of accounts, such that when you go to the US, you go to Canada, all these will depict similar or same format. So the rules of accounting or accounting standards will depend on what entity we have, whether it's a private or a public sector. So we have what we call the International Financial Reporting Standards and International Public Sector Accounting Standards. So for public entities, they need to follow the IPASS. For the private sector, they follow this other accounting standard. So the rules of accounting and accounting standards for the private sector. So the private sector companies will follow the International Financial Reporting Standard. So here is a list of the number of them. There are a number of them. Standard 2 looks at inventory, Standard 7 looks at cash flows, Standard 10 looks at events after reporting. So these ones are just but to mention. There are a number of them. You don't need to master them. So these are as many as they can be. So now we also have what we call a conceptual framework. This is simply a comprehensive set of concepts for financial reporting. This framework contains concepts that will guide the decisions that the board will make in developing standards. So we have the latest for 2020, which was revised initially from 2018. Any questions so far?
No questions.
All right, so the purpose of the conceptual framework, number one, is to develop the board to direct the accounting standards, to assist those who prepare the report to develop a consistent policies that will guide, and also to assist all parties to understand these and interpret the standards. That's the purpose of the conceptual framework. Now, there are terms that you need to understand that are called elements. We also have what we call characteristics. So we have 5 key elements. We have assets, we have equity, we have income, we have expenses. All right, these are called elements. We have liabilities. So we have also what we call qualitative characteristics, so which will be subdivided into 3. So just to look at them, the objectives of the financial statements are to provide information that is useful to users for decision making. Now, the framework is concerned with the general purpose of the financial statements. So a complete set of financial statements should include a statement of the financial position, which is a balance sheet, a statement of the comprehensive income, which is the trading profit and loss account, and also cash flow statement. Now, we have 5 elements that we need to know: what are assets, what the business owns, what are liabilities, what the business owes, what is equity, what the owners have put in, what are revenues, what are expenses, or gains and losses. So these collectively make up what we call the elements of financial statement. So by definition, assets will present an economic what? An economic resource controlled by the entity as a result of past events, whereas a liability present an obligation of an entity to transfer an economic resource as a result of past events. So a resource has potential to produce economic benefits, whereas an obligation has no ability to give economic benefits, but a liability such as loans and creditors. Expenses will always decrease our assets. They will in fact increase the liabilities, whereas revenues will increase assets, but will decrease in liabilities. So we'll learn how to treat these ones as we go. When we're dealing with equity, we're looking at the amounts that have been put into the business by the owners. So on the characteristics that we have, which we call the qualitative characteristics, we'll divide them into the fundamental and the enhancing characteristics. So under fundamental, we have characteristics that look at relevance and faithful representation. These are foundational. That's what they're called, fundamental. Then we have enhancing characteristics like comparability, timeliness, understandability, verifiability. All these are called what? Enhancing characteristics. So RF stands for relevance and faithful representation, which for fundamental qualitative characteristics. CTUV, comparability, timeliness, understandability, and verifiability all make up what we call the enhancing characteristics. So under fundamental characteristics, like I said, we have the RF, which is what? Relevance and faithful representation. So information must be relevant and also provide a faithful representation of what is purported to be presented. So these should be on the assumption that whatever is presented in your statement should be a faithful representation of what the business currently stands. So relevance is that whenever we're producing information, it must be there should be a difference. It must make a difference to the users of financial account information. It must be relevant to them. Financial information is also capable of making a difference in decisions. When you go to faithful representation, it must present the substance of what it purports. So a faithful representation, the maximum extent possible. A faithful representation is affected by the measurement of uncertainty. When we go to the enhancing, we said CT what? V. Must have what? Comparability, timeliness, understandability, and verifiability. So by this, we mean understandability information must be presented in a way that the layman must understand. When we're talking about complex things that they don't understand, it may not fulfill the enhancing characteristics. Verifiability, it means the information must be what? Verified by auditors that should help users to use information for decision making. Must be verified. Comparability simply means that this information with time and trends must be comparable. That's why we do ratio analysis to compare how the performance was. Must have a comparability. Timeliness must be provided on a timely basis. It must not be outdated, must be within time for useful decision making. So we also have underlying assumptions. 5 key underlying assumptions that underlie the financial accounting. So number 1, reporting entity. This simply implies that you must assume a company to be different from its establishment. These are separate legal entities. Going concern simply implies that you should look at a company to have a foreseeable future, that even if it was established in 1960, it should be seen as if it is one company that will go for a foreseeable time. Monetary unit assumptions that we will always value all concerns in monetary form. Periodicity simply implies that at every moment, every company must have regular points at which reports must be recorded at the end of every 6 months, every year. So that's the period which we call periodicity. So these are the basic assumptions. So going concern reflects the assumption that what? A business will continue to operate instead of being sold or closed. Monetary, the transactions and events should be in monetary units. Reporting simply assumes that an entity will choose to prepare financial statements. It's separately regarded as a business, being its own owner. Periodicity simply assumes that the life of a company is divided into time, months, or years. These are quarters. Then we also have what we call the accounting principles, which represent cost, recognition, matching, and disclosure. So the historical cost concept simply assumes that we must value all our assets according to the costs that they were initially bought. Recognition simply assumes that when we make a sale, we should recognize the sale or a revenue at a point when we make the sale, not when we receive the money. Matching concept simply assumes that we should only realize an expense within a period in which it pertains. So if we make a prepayment for the following year of electricity, you should not charge it that particular year because it does not match with the year in which it was incurred. Full disclosure simply means that we should inform the end user, the reader, with all information that they need, with footnotes if possible, so that they could make good decisions relevant to their decision making. So these are the concepts that I've just summarized. So recognition simply says that recognize revenue when it is earned. All right. So a measure of cash received plus value in terms of items. Costs based on our actual costs. Matching, company should record expenses incurred to generate as is reported. Full disclosure, company must report details behind the financial statements that would impact the user's decisions. So we also have constraints, which may include costs, industry practice, and conservatism. So these constraints in reporting are the assumption that the benefit of providing information needs to be justified, needs to justify the cost of providing them using information. For instance, cost of materials, etc. Industry practice when preparing, we also need to take into consideration the industry practice because certain things must conform to the industry requirements. And conservatism or prudence simply assumes that the accountant should adapt to procedures which do not overstate or anticipate revenues that will understate the expenses. So sometimes you need to use the prudence concept to avoid people overstating or understating profits in their financial statements. So this is where we end, and we'll quickly go through the questions from the quiz. Unless any questions at this point. So based on what has been discussed, now we'll look at units 1, quiz 1, and quiz 2. So question number 1, which one of the following is not an example of a partnership? 1, unlimited company. 2, a law firm. 3, accountant practice. 4, private university listed in the stock exchange. So which one is not a partnership? So number 1, unlimited company is not a partnership because it's unlimited. Number 2, which one is not a partnership? We have a private limited company listed on the stock exchange. It's not. Accounting practice, yes, this one is a partnership. A law firm, these ones are partnerships. So our answer falls at C. So, but question number 2, partnerships are formed. When partnerships are formed, it is not imperative to have an agreement. When partnerships are formed, it is not imperative to have an agreement. When partnerships are formed, it is not imperative to have an agreement regarding what? So what each partner must do, this one is important. How many hours partner must work, and it's important. How the profits should be shared is important. How much money each partner must get, this one is important. The limited liability for each partner, this one is not important. All right, which one is not a purpose of accounting? To provide information to non-users. It is only for users. For users, for users, for users, for users. All right, so D is out. So customers are primarily interested in following information of an entity. So customers are primarily interested in the following information. Number 1, timely payment of the suppliers. No. This one is for who? The suppliers themselves. How the firm is financed. No, these are the functions of financial accounting. The going concern of an entity, yes. To know whether they'll be given assurance that the monies will be paid. Working conditions of employees, no. Which user of financial accounting information is interested in the current and future profits of the investment, which is reviewed by their financial strength and solvency? So it is a shareholder or prospective what? Investor. Are you following through?
Yes.
So which of the following statement defines management accounting? So it is a measurement, process of identifying, measurement, accumulation, analysis, preparation, interpretation of communication, and management. So it is D. We read it through. So one advantage of limited liability is that you are limited to, there's limited liability for the shareholders. The financial statements comply with the legal requirements. It's difficult to reduce share capital. There's need to publicly disclose. There's limited liability to shareholders. That's the advantage for limited liabilities. Specifically, what you have invested is how much, if you had an insolvency, could be attacked. That is advantage. All right, which one of the following are external users of accounting? Management, that's internal. Directors, internal. Employees, internal. Shareholders are external. Which other external do we have? External auditors, tax authorities, creditors are also external. All right, which of the following statement is true about sole traders? Sole traders. So sole traders entity or owned by one person. That is true. Only by the owner. Okay, the sole trader does not have employees. That is not true. I have one. Sole trader need to publish their financial statements. That's not true. Sole trader is owned by one owner. Yes, one owner. Financing can get from friends. So that is our answer. So that is where we got a 9 out of 9. Quiz 1. All right, so we go to our second quiz from Unit 2. Which one of the following is not a requirement of the Companies Act? So a statement. Which one is a requirement? A statement must be signed by directors. Number 2, which one of the following is an example of an element within equity? So reserves are elements within equity, within what? Retained profit. The objective of financial statements is to provide financial information useful to users in making decisions. So users. Which of the following is an enhancing quality or characteristics? Remember, CT what? CTUV. So we have what? Do you remember them? Which one is? There is timeliness, understandability, verifiability, consistency. So we have understandability. Which of the following is not a current value of measurement base? Which one is not a current value of measurement base? Value in use, historical cost, fair value, current cost. Which one is not? Okay. So we put historical cost. Are we together so far?
Yes.
Then when we go to question number 6, the conceptual framework for reporting is a comprehensive set of concepts for financial reporting issued by the International Accounting Standards or the board. So it's a comprehensive. Which of the following elements match the following with the correct definition? Assets. These ones are a resource controlled by an entity, passive event. Equity, amounts put in by the owner. Liability, obligation of transfer of economic resource. But these are, you have to choose from them. So the revised conceptual framework for financial reporting became effective in what? 2020. That is true. The initial was what? 2018. Which of the following is not a purpose of conceptual framework to financial reporting? Again, is not a purpose of conceptual framework to assist users of financial reporting to develop consistent accounting policies for transactions over other assets with no standard applies or a standard that allows a choice of accounting profit. To assist all parties to understand, to assist preparation of reports, to develop accounting events with no standard or standard allows, to assist accounting on consistent reports. This one is correct. Assist all parties to understand and interpret. This one is correct. So one of these two, which one is not a function of the financial reporting or the conceptual framework? So we picked to assist financial reports to develop consistent accounting for transactions or other events where no standard applies. Then we go to conceptual framework for reporting is concerned with the general use of financial statements, i.e., a normal annual statement. It can be applied to other types of accounts. So a complete financial statement does not include cash book statement of the financial position, yes. It includes this. Comprehensive statement, yes. It includes this. It also includes what? The cash flow statement. So the only thing it doesn't include is what? The cash book. So this is where we end. Or we have some more. Which of the following is not part of the regulatory accounting? So we have national company regulation. This one is part. Corporate governance, the national reporting standard, the stock rules. So we had a diagram which looked like this, which showed the entities as has been presented. So everything basically comes from the module. So if you understand, just a quick can you remember? So we had looked at this diagram just slightly above here, above this one. So which one is not? So we have a stock exchange, national company registration, and international reporting standards. So which one is not? Corporate governance. So we have national company, national reporting standards, stock exchange. So this one is not. So match the following classifications. Revenue recognition. Is that a principle or assumption or element? It's a principle. Going concern, assumption. Share capital is an element. Then which of the following is not an international financial reporting standard? Provide a common form of content and financial reports issued by International Accounting Standards Board. They are issued by International Public Sector Accounting Board, National Reporting Standards, authoritative pronouncements that explain how to deal with specific accounting. The correct answer was, which one is not? It is here. But C. Right, so our attempts, we only missed one. So this is 16 out of 17. So you don't necessarily have to get everything, but basically, this is how it ends. Are there any questions?
No questions, that's clear.